Welcome to our comprehensive New Zealand dollar to Canadian dollar analysis report covering the period from October 13th to 18th, 2025. In this presentation, we'll examine the technical and fundamental factors driving this currency pair, identify key trading ranges, and provide actionable trading strategies. This analysis is brought to you by FX Tech, your trusted source for professional Forex market insights. Let's dive into the data and discover what the charts are telling us about the New Zealand dollar versus the Canadian dollar. As of October 20th, 2025 at 7:02 GMT, NZD/CAD is trading at 0.80394 Canadian dollars, showing a modest daily gain of 0.16%. The pair opened at 0.80302 with a previous close of 0.80266. Today's trading range spans from 0.80189 to 0.80458, with volume recorded at 8,560 ticks. The technical indicators present a neutral picture across the board. Both oscillators and moving averages are showing neutral signals, suggesting the market is in a state of indecision. This neutral stance sets the stage for our deeper technical analysis ahead. Looking at performance across different timeframes reveals an interesting pattern. The very short term shows slight gains, up 0.16% over 1 day and 0.14% over 5 days. However, as we extend the time frame, the bearish trend becomes evident. The pair is down 0.94% over 1 month, 2.41% over 6 months, and 3.82% over the past year. Year-to-date performance stands at negative 0.04%. This data clearly illustrates that short-term gains are masking a longer-term bearish trend, a crucial insight for traders considering their time horizons. The Investing Live technical analysis reveals conflicting signals across different timeframes, which traders must navigate carefully. On the 30-minute and hourly charts, we see strong buy signals, suggesting short-term bullish momentum. The 5-hour time frame shows a neutral stance, indicating a transition zone. However, the daily, weekly, and monthly charts all flash strong sell signals, confirming the longer-term bearish trend. While technical indicators lean towards strong buy and moving averages suggest buy, the overall summary is strong sell. This divergence highlights the importance of aligning your trading timeframe with the appropriate signals. The Baby Pips chart art analysis identifies NZD/CAD trading within a descending channel on the 4-hour timeframe, characterized by falling highs and falling lows. Key resistance levels are identified using Fibonacci retracements. The 38.2% level at 0.8110 coincides with R1 near the mid-channel area. The 50% level sits at 0.8135. The 61.8% level is at 0.8165, and the channel top near R2 is at 0.8210. On the downside, support is found at the pivot point of 0.8060 and S1 at 0.7960. Critically, the 100-period simple moving average remains below the 200-period SMA, confirming that the path of least resistance is to the downside. Understanding the fundamental forces behind this bearish bias is essential. On the New Zealand dollar side, we have several bearish factors. Dovish RBNZ policy expectations supported by weakening economic conditions, CPI at 3%, which is at the top of the RBNZ's target range. Yet rate cuts are still expected, and the RBNZ cash rate projected to bottom at 2.00 to 2.25% down from a 5.5% peak. Meanwhile, the Canadian dollar enjoys supportive factors, the strengthening US dollar providing a lift, crude oil price gains supporting the commodity-linked loonie, USD/CAD, trading above the 1.4000 psychological level, and reaching 6-month highs, and the Bank of Canada maintaining a cautious data-dependent stance. Several key developments shaped the market during this period. From New Zealand, the CPI jumped to 3% in Q3, hitting the top of the RBNZ's target range. Despite this inflation uptick, the market has fully priced in a November RBNZ rate cut of 25 to 50 basis points, and the NZD/USD bearish bias holds firm. The RBNZ cash rate is projected to bottom at 2.00 to 2.25%. From Canada, the Bank of Canada's next rate decision is scheduled for October 29th. Governor Macklem expects soft economic growth in the second half of the year. USD/CAD has reached 6-month highs, breaking above the 1.4000 psychological level, while trade tensions and tariff uncertainty continue to weigh on the Canadian economic outlook. For the next 1 to 2 weeks, we're looking at a trading range between 0.7960 and 0.8110, with a bearish bias. The pair continues to trade within the descending channel pattern. A break below the 0.8060 pivot point could target the 0.7960 support level. Any upward corrections are likely to face resistance at the 0.8110 level, which aligns with the 38.2% Fibonacci retracement. The technical setup is clear. The 100 simple moving average below the 200 simple moving average confirms the downside bias. Traders should watch for reversal signals at these key levels and practice proper risk management. Looking at the midterm outlook of 1 to 3 months, we're projecting a range between 0.7830 and 0.8210, maintaining a bearish bias. The fundamental divergence between the RBNZ's easing cycle and the Bank of Canada's data-dependent stance supports this bearish view. The 52-week low at 0.7828 represents a potential target if the downtrend continues. Both central banks are facing economic headwinds, but the RBNZ's more dovish stance gives the edge to CAD strength in this pair. Visualizing the midterm range, we see the channel top and R2 resistance at 0.8210 marking the upper boundary. The current zone sits around 0.8040. Range support is established at 0.7830, just above the critical 52-week low at 0.7828. A break above 0.8210 would be needed to invalidate the bearish bias, while a move toward the 52-week low would confirm the downtrend strength. Trade tensions and tariff uncertainty add to market volatility, making risk management essential for any positions in this pair. For our preferred bearish scenario, traders should look to sell rallies toward the 0.8110 to 0.8165 resistance zone. Target the 0.8060 level first, then the 0.7960 level for a second target. Place stop losses above 0.8210 to protect against a trend reversal. For those considering a bullish alternative scenario, wait for a confirmed break above 0.8210 before entering long positions. Target the 0.8300 to 0.8400 range, with stop losses below 0.8110. Most importantly, monitor the RBNZ decision in November and the Bank of Canada decision on October 29th closely. Use appropriate position sizing and never risk more than 1 to 2% of your capital per trade. Let's summarize the 5 key takeaways from this analysis. First, NZD/CAD is in an established downtrend within a descending channel. Second, fundamental divergence between the central banks supports the bearish bias. Third, the short-term range is 0.7960 to 0.8110. Fourth, the midterm range is 0.7830 to 0.8210. And fifth, selling rallies is the preferred trading strategy. These insights provide a clear framework for approaching this currency pair in the coming weeks. 3 major catalysts will shape NZD/CAD's direction in the near future. The Bank of Canada's rate decision on October 29th will provide crucial guidance on Canadian monetary policy. The RBNZ's decision in November will clarify New Zealand's easing trajectory, and ongoing U.S.-China trade developments will continue to influence global risk sentiment and commodity currencies like the CAD. Stay informed on these events, as they could trigger significant volatility and trading opportunities. Thank you for watching this FX Tech analysis. Trade safely and stay disciplined.